Adrian, thanks so much for having us, to you and the Naturally New York Network. For everyone else, thanks so much for joining. Happy to answer all the questions, but I think first and foremost, very quickly around RCV Frontline. We're a fund that invests in early stage food, beverage, and some food technology. Early stage to us is usually defined as companies in the 1 to 5 million revenue run rate. We use that run rate to invest in companies that could be below or above that threshold, depending on other factors. Veronica, thanks for joining and looking forward to where it's amazing to have her on here, who's a founder who's been through this cycle of fundraising and exiting and adding more to the community. So thank you so much for joining.
Yeah, it's great to be here. I appreciate seeing all of you joining us today. My background is, like Andrew said, I am a founder. I started a company in my kitchen in Holland, Michigan. I did not have family money, and I did not have a lot of personal money. So I definitely had to be scrappy and use the resources around me. So I'm happy to share my personal story with that. And then also, since then, I've done a lot of coaching through JPG Resources with small startups. And as you all know, a big part of that is helping them manage their finances and also find investment and capital to continue growing. So I'm happy to share and answer questions around that experience as well.
Great. Well, maybe Veronica, maybe it makes sense to give a little background around how you started with that funding and answer some of those questions, and then I can kind of jump in and give a perspective from the fund standpoint.
Yep, I think that sounds great. So I started a company called Pure Organic in my kitchen here in Holland, Michigan. I started making just simple fruit and nut bars for my daughter, who became a vegetarian. At the time, it was 2005 or so, there really wasn't anything similar to that on the market. I used all organic, simple ingredients. And so I started looking into the possibility of making them on a larger scale. Started talking to some manufacturers actually pretty early on. Michigan has a lot of those in the area because of Kellogg, and we are just a manufacturing state. So I learned a lot about what it would take to actually manufacture my product and how that would affect the costs. And during that process, I learned about buying ingredients on a large scale. And so how I grew my business was really just simply at first locally, eventually targeting the bigger distributors. And about 2.5 years into it, I was in KHE, I was in UNFI East, and I was still really a one-woman operation with a part-time shipper. So at that point, I knew that I needed funding, I needed partners, I needed intel and infrastructure in my business. And so I created a very unique deal with a group of investors, a small venture capital firm out in California. I gave up more ownership of my company than probably a lot of people do, but I retained equity and I had a royalty deal. And so I guess my advice to people is always to think really creatively about how you can put a deal together and think really holistically about the whole experience. Because if you can do something that helps your company survive and thrive and really become something, then maybe full ownership or majority ownership isn't always something you need to retain. But anyhow, that's a little bit about my experience. We grew it, the investors and I grew it together for 8 years, and then we sold to Kellogg under the Kashi family of brands. I worked within Kellogg for 3 years to manage that transition and learned a lot about big CPG. It was a painful experience, but also a growing and learning experience. I think it refined me as a businesswoman, and left Kellogg in 2019, and I've been coaching startups ever since. So that's kind of the high level. And like I said, I'm really happy to, when we get into question answer, go into some more detail.
Thank you very much, Veronica. I think you touched on every element from producing, buying ingredients, to route to market from your locals, to getting the bigger distributors, staffing, and ownership. So a lot of the elements that you think about as you go out to raise capital. And I think as I think about raising capital, and kind of some of the questions we get often is, one, how much capital do I need? What's my valuation to bring that in? Who do I raise capital from? How do I find them? And then what do they want to see? So those are the basic elements, I think, as you go out. And I think depending on what stage your business is at, those answers will change. I think we look at, what stage is your business? Is it pre-revenue, meaning, you have no revenues yet, you have your concept, you want to get out there, bring your great concept to market. Then you have maybe post-launch where you're sub $1 million, you're out there, you have some sales, you're learning, you've produced, and you're getting a little bit of traction. Then maybe early growth, so maybe 2 million to 5 million stage where you have demonstrated demand, you've done a couple production runs, you're growing, you need capital to fuel that growth. And then companies north of 5 million that are starting to attract a different audience of investors that are growing pretty fast. They may be profitable, maybe not, most likely not in most of the cases. But that's kind of the early stage range and how I think about them. So as you look at, all right, that's the range, how much do I need? That number is always kind of going to change depending on, what business you're in and those stages. But one question is, or one way to think about it is always kind of milestone based. And where do I want to get to with this round? What's my goals? If you're pre-revenue, maybe that's, all right, I want to set up a co-manufacturer or my own manufacturing. I want to get sales and maybe I want one hire, whatever those pieces are. Try and backtrack into how much do I need to do that? How much do I need to produce my product, to produce packaging, to get it from A to B, all those elements. And that's your initial use of capital, your proceeds that you need to go out and reach those initial milestones. If you're out there kind of post revenue and you're doing the thing, it's the same exercise. Now say, okay, now I've got $500,000 in sales. I think I can grow, to $2 million in the next 18 months or whatever you're looking at there. Similar exercise. What do you need to get to that milestone? Do you need to hire? Is it all for working capital purposes to produce and get your product out there? Or is it marketing for that? So all those elements to think about those and do it kind of backtracking from what that milestone you want to achieve at that early stage and how much is it going to cost to get you there. It is one method that I think is helpful to think about it. And I'll stop there for a sec. Veronica, any comments?
Yeah, I mean, when I think about the early stages, and you mentioned this, it's so important to have traction on your business. And so even if you haven't reached certain milestones, if you can prove that your velocities are strong in the stores you're in, and that you've been able to duplicate that and your traction with your product is really good, it's showing good sales and it's showing popularity across, different types of retail and different types of demographic. That's what really helped me. And another thing that you said, Andrew, that resonated is, there's going to be several, options for you to choose from to try to find funding. So, from my experience, I could have gotten a bank loan, right? Or you can get a line of credit against your house. I had a single guy investor that was interested in investing capital, but I realized for my situation, I felt like I needed that team around me because I had no food and beverage experience. And so I didn't want to just get money coming in and have to build the team myself. I wanted to try to find a situation where I could get investment and I could get experience and infrastructure at the same time. There was also a local, and then there's one of these in most towns. There was like a local small business accelerator that gave out loans to companies, low interest loans to companies that were showing promise. So that was another option for me. But again, it was just an infusion of cash where what I wanted was more than that. I wanted a team and I wanted expertise to help me grow the business correctly.
And that's a great point. Those kind of 5 questions that I asked earlier: how much do I need? What's my valuation? Who do I raise money from? How do I find them? And what are investors looking for? That applies to all those different stages that I mentioned. So if we think about kind of that early stage at pre-rev, what are your options out there? That's most likely friends and family. I don't think you're going to have a lot of small business loans options, but you might. Those friends and families are typically the ones that are going to start. And if you don't have that network, maybe it's some of those community banks, like Veronica mentioned, perhaps pitch competitions and other things like that. But at that early stage, it is difficult. There isn't a silver bullet to say, here's capital that's going to fund my idea. It's probably going to be a function of your network to a large extent. As you scale up a little bit, there become more options. Like if you're at that post market, now you have a little bit of traction. You can start entertaining conversations with perhaps more angel investors, the family offices of the world. Most funds, it's probably still too early if you're sub $1 million in sales. And I use that as kind of just a rough number there. I think we use that run rate as a means to understand the traction that the company has gained. And what does the founder learn by getting to that stage? Do they know the nuances of the channels? Is that online sales? Is that in stores? And kind of what have you learned at that point? And do they have a clear understanding of where they're going to go and what the costs are associated in expanding? So those early ones on kind of what are those sources out there, those friends and family, the pitch competitions, some fundraising platforms. Brainjectory, I think, is a great product, a great service out there for discovery. I think a lot of investors do sit on that site looking at early stage companies. The accelerators and incubator programs is another option that might be a great fit for some companies at that stage, from Beyond Brands and the SKU programs to Mondeleza's programs. They're highly competitive, but they're great visibility to help grow your company and also get some great advisors along the way. And how do you find them? It's, again, no easy answer here. I think network is a big part of it. And by the way, if you guys find great family offices, please let me know, because we're constantly looking for them too, as we go through the same headaches of raising capital on the fund side, just a slightly different audience, I think. One resource that's across all those different stages that I mentioned is Twitter. You might laugh, but everyone is extremely accessible. And if you start just searching other brands you might like, you'll see conversations from those founders, some of their investors, and everyone has been so accessible, from family offices to companies that we've invested in. So I think it's a great underutilized resource as you think about raising capital and where to go and company or people discovery. Now, coming back to what do the investors want to see? Again, I think about using that stage as a matrix of what do they want to see at each stage. And on that pre-revenue, you're selling an idea and the notion that you're the right person to grow this business. You've identified either a gap in the market or a product that can relieve a pain point, and you're the right person to do it. So I want to know, what is the issue? How are you solving it? Why now? And why you? Do you have other people around you? Have you assembled a great team early on to grow it? Have you had great experience in the space? Is there any secret sauce that allows you to have a competitive advantage from others? All those factors are those early questions that you're going to want to be prepared to answer at that pre-revenue stage. And Veronica, please jump in at any point here, if any comments.
Yeah, I mean, just thinking of my early funding, I had $100,000 line of credit that I drew from to support my manufacturing runs, and then I was able to open and then beg for larger and larger credit card amounts on a 2% cash back credit card. So you would basically fund a manufacturing run, put it on my credit card. I had 30-day terms with my manufacturer. My credit card gave me another 30 days. By then, my vendors were paying me So it allowed me to have a cash flow to support that really early stage growth. Obviously, that's not sustainable, because if you've got a great product and you're growing quickly, you're going to grow out of something like that, which is a good thing, but also that's when you need more capital. But that's how, as a really early stage, just starting to grow company before I had proven myself, that's kind of how I manage my cash flow.
Great. And I see we had a question here from Kimberly regarding how do you know how much capital you need? And I think this is always a really tough one, but I think it's discoverable. If you're at that early stage and you're either producing yourself or with a co-man, that's probably your primary use of funds at those early stage, is to create product to be able to sell. And I think to get that, you should be able to get a fairly clear understanding from what the costs are for your main ingredients, what your tolling fees or manufacturing fees are, and put that together, and then some money for marketing. If you haven't set up a website yet, that's another use of funds. So I think it's backing in, it's identifying how are you going to make your product, what are all those inputs, and what's that cost that you need there. Having a cushion, because things happen, things go slower than you always want. Sometimes there are hiccups in that manufacturing process. So to try to build in a cushion to that amount of capital that you're identifying is always critical as well, in my opinion.
Yeah, I would just also say that, obviously your minimum order requirements are going to drive everything from your ingredient purchasing to your manufacturing. But what I always tell the people that I'm coaching is make sure that you have a line of sight to where you can optimize your margin. So exactly where, as you buy more of your largest ingredients, where your price breaks are going to come, where your transportation price breaks are going to come, and where your manufacturing price breaks are going to come. In the beginning, especially when you make that leap to manufacturing, my margin was terrible when I started out. And, I don't know if this is the right way to do it or not, but, I had an under 20% margin through moving into manufacturing, because I was buying the least amount, the smallest amount of ingredients, doing the smallest runs. But manufacturing got me on shelf, and I had enough traction, and I had proven myself enough at that point where I knew that if I grew to certain levels, that margin would start ticking up, 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 up. And eventually I would get to the place where I could optimize that margin. So for me, having a poor margin in the beginning was necessary to get me on shelf, to allow me to scale my business, grow my margin, and then attract more investors. I'd be interested, Andrew, as an investor, what you think of that strategy. But there's, I just see it over and over again with small companies going into manufacturing, how it's really, really hard to have an optimal margin, especially in the beginning. And a lot of them get in trouble because they don't have a path to that margin optimization. But I feel like as long as you have that path and you can get there by scaling your business, that it's okay to do that. But what do you think?
I think I agree completely. Most of the companies we're looking at this stage don't have an optimum margin. We know that, we understand that. Myself, my partners have all been operators as well, and we appreciate that. And to Veronica's point, it's having that bridge. How am I going to get improved margins? Is that scale going to provide you better pricing on your ingredients? Is your tolling fees or co-man fees going to get lower as you scale? Those are the kind of some of the drivers that can improve your margin. So having a clear understanding, say, we're not where we're at, where we want to be right now, but we have a very clear path of how to get there. That's what we want to hear from those early stage founders. And I think one tale of caution is, scale doesn't fix everything. There's a lot of costs that keep associated, that you're going to have a larger working capital need as your business grows, and making sure you can fund that growth is a big part of it. As that scale comes in, more financing options come in from the Amplas and Dwight Funding of the world and others that can help on that piece of the business. But I agree completely with Veronica that the investors that you're speaking to should appreciate that at an early stage, your margin is not where you want it to be, but it's up to you to communicate that and to communicate that you're aware of that and that the levers to pull to get it to a place where your business is becoming sustainable.
Yeah. And I would say, two things I learned along the way is to just be uber focused or have a person or a team that is uber focused on the back end of your business, because saving, a penny or even a quarter of a penny, when you start to get larger volumes on the back end is so much better than raising your price on the front end, right? Because everybody takes a piece of your front end price, but your back end is real money, it's real savings. And so, even those tiny savings through transportation, through warehousing, keeping the negotiations open with all of your vendor partners at all time is so important to having your margin where you need it to be. And then the other big learning is, especially when you're young, budget for and spend your trade spend, which is a spend that comes out above the line. It is something that's really painful to budget for especially for a small company, but your trade spend is basically all of the spend you're doing with your retailers on shelf. It gets a tag on your product. It gets you noticed in store. It's one of the closest, it is the closest way to spend towards your customer. In the beginning, trade spend is much more important than having all of the social media presence and, the influencers and things like that. That I think comes later. But what you have to do as a small brand is you have to have good velocity on shelf so that you stay in your retailers and that you can create a success story and talk about that to investors. That's what you need to worry about. That will drive success, that will drive growth, and you'll get to the point then where you can really, drive that branding and awareness through more spend on the social side. I see we also have some questions here.
I was going to ask Adrian, should we wait for those questions to the end, or how do you want to handle those?
Whichever you prefer. I'm keeping track in order over here. Okay. So if you're ready for the next one, I'll share the next one.
Maybe we touch on a few other subjects, and then save the questions for the end, and we can kind of tick through a lot of them, if that makes sense.
Perfect.
Does that work for everyone? And thumbs up or thumbs down from faces out there? All right, thank you. So I think Veronica's last point on the velocity and kind of gaining that traction is a key point. Is a good segue into kind of what are the investors looking for, and whether it's that early kind of post-launch or that kind of next stage from that 2 to 5 million range or above. It's traction, it's velocity. Do you want to see demonstrated demand for your product on the shelf? And from us, we love to see kind of the execution and kind of getting to that point as efficiently as possible. So have you been able to bring in maybe grant money or other ways to kind of fund your business to ultimately get that velocity? And for me, I think one huge thing and a differentiator I see in a lot of founders is their discipline. If they understand that velocity is more important than signing on new retailers and kind of expanding geographically and having the ability and wherewithal to say no to some of the distributors who will be happy to open up a DC for you and let you kind of go hunting for another store. If you have that small footprint, then you can demonstrate great success and a rabid fan base. And then your pitch to that investor is, look, we have a great product. People are buying it fast. We need more capital to expand. This is a repeatable story, and we're going to bring it to X, Y, and Z retailers next. I think that's the most tried and true formula to raise capital on. Veronica, in your experience, how does that sound?
I agree completely. You've got to I see there's a question in the chat about, how do you attract investors? And I think a lot of what you just said, answered that question. Show that you're being smart with your money, show that there's a demand for your product, show your velocities and your increase, show what promotion on-shelf promotion and in-store promotion can do for your brand. Very important. And then, to just have that buttoned up and communicated in a professional way. Have a nice short sales deck, investment deck that you put together. I know we with the Beyond SKU program, we work on those, the pitch decks, with our mentees. Those are really important tools to open doors. And Andrew, you can speak to that too, but just, coming up and basically presenting yourself in a very professional way that shows that you have a viable business is important.
Absolutely. I think that the concise communication is always a standout. Sometimes you see a lot of the main points being dragged out, but if someone can be as concise on the value prop of not only their product, but the company and where you are, what the ask is and where you're going, it stands out from many of the other decks that we see. I was going to mention something else and I just lost my train of thought on it, but it'll come back in terms of that traction and growing and kind of what the investors want to see. That efficiency is always important. The traction is paramount. And in terms of that team, I think it's very hard to do alone. So I think you should always be thinking about, how do I scale my team? And I think today there's more resources than ever have been for the industry, from service providers that can provide fantastic go-to-market strategy, sales support, or on the operational side to have someone who knows what they're doing help manage your supply chain. So I think being aware of who's out there and showing that you're kind of building that team as efficiently as possible, whether it's early on, you say, I want to use third parties to help this, or you want to do it in-house, either is okay, as long as you have a clear strategy and you can demonstrate that you can afford to do so.
Yeah, as founders and entrepreneurs, we want full control over our company. And I think that's just like innate. We want to do everything. We think that we are the only person that can do everything well. And in some instances, some areas that might be true. But another big learning is just that you can't be everything to your business. And you have to surround yourself with good people. You are all very smart and very capable in your own right, but there are people and experts out there that can step in certain areas of your business and really escalate it and elevate it beyond what you could do. So I think it's hard to do, but it's necessary to search and bring in those right partners that can balance you out, so that you can concentrate on your strengths and really put 100% effort of your strengths into your business, and then supplement with people who are experts in the other areas. And investors love to see that too, because if you've got a great team, or you're using great resources out there, it shows that you're really thinking ahead and you're thinking about that and not trying to do it all yourself.
Yep, I'd agree. It stands out when they have the service providers there, or partners or advisors. There's one word of caution on the advisors. If you met someone at a trade show and you had a conversation, don't put them as an advisor, because we're probably going to call them. It's a relatively small world. And if they're not truly advising, or they say, I met that company once, it doesn't show well. Coming back, maybe Adrian, we can start going to some of the questions. They seem a lot to be focused on some of the current environment and kind of operation questions, which I'm happy to dive into, but also want to say, is there anything we haven't touched on, from say the valuation to the securities you use as you raise, any of those aspects? Please let those questions come in, and we're happy to address all of them as best we can.
Okay, so Andrew, the next question is, how did you choose your mix of retail and food service, and why? Well, I think that's more Veronica, but
Veronica, do you want to start out? I can touch on it with my business after if you want.
Yeah. So for my product, I started out selling in local natural food markets and online because that was the most accessible. It was the lowest hanging fruit. I could get my start there. I could vet my product. I actually went into Amazon pretty quickly. I will say it was easier to do that over a decade ago, to hop onto Amazon as a small brand. But I basically, used what was easy to do to vet my product and understand how my product performed in market and how, who was buying it. And, when you're doing demos at your local natural health food store, you can kind of see who's buying your product. You can have conversations with people. You can start to really understand the data, and the insights around your product on a case-to-case level. And that type of learning, I think, is really important. Even being online and getting customer feedback online, having people subscribe to a newsletter so you have their email, so you have kind of a core tribe that you can talk to about growing and innovation. All of those resources are really important in the beginning. So I would say in the beginning, choose what's close to you and accessible and will, give you good data. From there, my goal was, and part of it is just because of the product that I had was not really relevant to food service. I went, straight into KeHE, which was my first distributor. And, KeHE at the time served 9,000 doors. They're much larger now. But I basically used KeHE as my sales force and my only distributor for a time. And I said, I'm going to, concentrate 100% on KeHE. I went to the KeHE shows. I created relationships with their sales reps, talked to them about how this product is unique and different. And I got a lot of traction in a lot of KeHE outlets. So that's really where I started to see growth for my business. Never really moved into food service, but as we grew as a company, we found out that some of those kind of discovery alternative places like airports and college campuses worked really well for a product like ours, for like a bar and a bagged snack. So we started, probably 5 years in, we really gave a push to a lot of those sales channels that are serviced by some of the same distributors that service food service. So that was really beneficial for us because those channels, there's a lot less noise on the shelf, right? And so people will discover you there, and then they'll go to Whole Foods or Meijer and look for you there. And so it just helps pull that product off the shelf. It almost acts as like a marketing tool to be in those smaller venues, even the like little bodegas and stuff in New York. That strategy really worked for us. Once we were in some larger retailers, that helped us get noticed on shelf with those larger retailers. So that's kind of why we went to that strategy. That was a long answer, but that's kind of how we built out our bar and snack strategy sales channel.
And on my end, we had a water company with an environmental differentiator. And as we looked at kind of food service and retail, food service, we thought there was so much hope in it, that it was this environment where kids on college campuses would love our products, the airports would work, other food service environments. And what we found was that it still seemed attractive, that it was an easier buying process, not as many discounts. You get your full purchase order, dollars paid back. We found it to be a very tough sales cycle to navigate through the ultimate end buyer to the distributor to maybe the food service management company. And also in many cases, at least in our world, some of those channels and within that such as education, they bought on really a cost basis. It was a bidding process for the product, and we just simply could not compete. So food service, in our case, while it looked very attractive, the more we got into it and got to understand it better, we realized it wasn't a great fit for our specific product. So that kind of drove us back into retail, where we focused more and kind of learned a lot of the mistakes that, preaching here, from expanding geographically too much and then having to retrench a little bit, build up the velocities, and then go back, was something I lived through, and really painful, expensive. And if someone would have told me to shortcut that last time, I would have been much happier and probably more successful in that venture. Looking at, sorry, go ahead, Adrian.
Sure. So in addition to margin improvements through scale, how have you advised emerging brands to address higher inflationary climates like now?
I think it's watching your spending like a hawk, making sure you can supply your product to your customers. There's a lot of hiccups right now. Inputs are getting higher. So one, securing that you have product. And then in terms of watching those costs, what does that really mean? Is understanding, if you're of the retailers you're selling in or all the different channels, are there some that are just simply not profitable? We're trying to understand as much as possible that contribution margin coming from those different accounts, who's really working, who's not, and be ruthless on kind of scaling back in some cases where they might not be profitable. A big lesson that I learned was it's okay to stop selling into one channel or one retailer while everyone will tell you that door closes and you can never get back in. I don't think that's necessarily true. And I think you can. It might be harder, but I think that it's paramount to keep your business alive. It is the first and foremost thing. And then looking at your ancillary spending, whether it's digital marketing or others, where can you spend, where can you pull back on spending, and try and run your P&L as efficiently as possible, and really look at, are you getting a return? Is that spend generating more sales?
Yeah, there's so much good stuff there. We also learned a painful lesson, and I actually would be interested in what you think about this. Is it ever the right decision to go into a major retailer if you have a lot of other retailers, right? So they're not your only one, but you're not making money with them. But you're in a lot more doors, you're getting a lot more, brand awareness. It's an accolade potentially to your brand. We struggled with that with one major retailer, and we ended up finally pulling out, which hurt our top line but improved our margin significantly. And so that's always an interesting question, if that's ever something you would do, and if so, when, or would you just never do that?
I think it's hard. I think it comes back to is, who's your customer? Where are they shopping? Are they in that giant retailer or not? You want to be where your target audience is. That's going to drive your velocity, right? And I think if you find out that it's not the right time to be in that retailer, and maybe you need to be a little bit more established, then you can push them off. I think it's having the logic to communicate that story of why you're saying no or yes. And if you say, we're going to be selling at a loss here, but it's going to be for X amount of time, and we think it's going to do this positive thing for us. It's going to get us, a year from now, better tolling fees or material costs, whatever that story is, and you can stomach it, that's okay. But just realize the cost to it, and can you carry through that period?
Yeah, I think that's great advice, and it's something that as you grow, a lot of brands really struggle with. And just kind of layering on to the question about how you do business in this climate. I think the whole back end of your business is so important. Having multiple vendors for the same ingredients, and potentially having more than one co-man at when you're big enough, so that you can really optimize that whole, that whole back end. And then, when you do your spending, if you're going to be spending for, targeted, if you're going to be spending for social ads, make sure that they are targeted in regions where your top retailers are, and you're really driving traffic to retail, and you're using it in such a way where you can see a return on investment. And you're not just putting it out there, excuse me, for a presence, but there's really a purpose to your spend.
Yeah, I think now in this environment we're all in, it's critical to try and run your business as efficiently as possible. If those marketing dollars, are not proving effective, or, it's every dollar in for $1 a sale, you just can't keep that going. It's not doing anything for you. You got to find a better path. Capital is going to be hard to find. Prices are going up. Inflation's no joke. It's hitting every aspect of the supply chain for all of us. So it's understanding, trying to forecast as often as you can, whether it's a 6-month cycle, and just know exactly where your costs are. Don't get surprised too much if your trucking rates are going up or if your warehousing fees are going up. You want to try and anticipate those costs as much as you can. And I think the best way to do that with a lot of those elements is the relationship you can form with the people at those companies. At the end of the day, it's someone you're talking to at your warehouse. It's someone you're talking to at the shipping companies, and trying to create that relationship, your co-man. If line time's getting thinner, having that relationship might be that difference that allows you to maintain that space versus getting dropped by a co-man.
Yeah, I agree 100%. Relationship is so important, and you can never let that go as you grow. I had some learnings around that when I started bringing in a team and, letting things go, not watching closely over those relationships or making sure that your people understand how important those are. It's really everything to have good relationships with your co-man, with your vendors, with your trucking suppliers, with your 3PL. It's so important.
And your investors. If something's going wrong or something, all of a sudden there's some event happened where you're now your runway isn't what you thought it was. Trying to hide that is probably the worst thing. And I think being very clear and upfront, say, look, this happened. I didn't anticipate it. We need to raise money for X, Y, and Z, or what do you expect? Is there anyone else in your network? Having those frank conversations with your investor base can lead to more productive results than simply trying to hide it and then surprising them, saying, we're done, or we need money in 2 weeks or we're out of business. That's not going to go over very well. So I think, again, that relationship, just staying informed, is really, really helpful.
Yeah. I see here there's a question. Did you continue to grow with UNFI and KeHE? And when did you become profitable with those distributors? I did continue to grow with UNFI and KeHE. I always had margin, but I mean, for me with them, it was about optimizing that margin, right? In the beginning, you almost do like a blended margin, because my margin was low, and so I wasn't making very much money through KeHE, but I was making money through my direct sales. But as my volume increased and I was able to realize those efficiencies on packaging and tolling and ingredients, then I was able to create a better margin through KeHE and continue to grow that business. So for me, I don't know exactly, the exact time frame, but it was really paramount to my business to utilize those distributors, because that was the only way I was going to get the scale that I needed to, to be profitable. And so, it does take time, and you have to be creative, especially in the beginning with your kind of a blended margin approach. But again, if you can map out a path to where your margin is where, your margin is where it needs to be for you to be a sustainable business, and you're able to achieve that and then continue to just ramp up your volume at that margin, that's where it gets, that's the goal, right? That's where it gets really nice.
I think maybe that's a point to stop for a second and kind of come back to the goal of this call is really on the fundraising side, I think, versus some of the operational nuances. So I think Veronica and I would be happy to chat about those all day. But I think coming back to Veronica's point, that's when it gets really nice, but you got to fund it to get there. And I think coming back to that question of how much do I need at those different stages? How do you identify that number? I think it's really milestone based. What do you want to accomplish in what amount of time, and how much is it going to cost you to do that? That's one way to think about it. That valuation piece for your early stage companies, it's one, there's methods and tools that allow you to push off that valuation question a little bit. As you raise capital, you're likely going to use one of three methods, which is selling equity, using a convertible note, or using a SAFE. The SAFE and the convertible note allow you to push the valuation question down the road. You don't have to answer it at that time or set something. If you're using equity, it's a conversation that's in that present, and most likely at those early stages, it's going to be a function of how much do you need, how much you prepare to sell of the company. So if you need $1 million and you say I'm prepared to sell 25% of the company, there's your starting point for a valuation of $4 million. At the end of the day, at this early stage, it's going to be a negotiated conversation between your investors and you. Whether that's friends and family, you want to strike a fair valuation for them and you, and that allows you to go out and do what you say you're going to do. And from there, hopefully you do it, and then you hit those milestones. You go out and you start addressing more and more people to help you raise additional capital. Who do you raise from? I think that friends and family is that early stage. As you kind of grow up a little bit and have more numbers to show, the main characters of the story that you're selling are changing a little bit. That pre-level, it's you and your concept and why you're going to do it. As you grow and you get on shelf and you start selling, it's your product. It's the velocity that you're showing. It's the retailers who are jumping up and down to put you on the shelf. Maybe waiving slotting fees, a great example to show, they really want your product. Or social media, you're generating a huge following, they really like it. That's great. Put those pieces out there to sell the traction that you're building. And how do you find them? Again, I think it's really networking is kind of the short of it. Going to some of these trade shows is helpful. It's very crowded. I wouldn't say it's the number one destination to go and find investors, but the pitch slams, applying to some of those, they're great visibility. The brand trajectory is a great spot to use, as well as the other accelerators other accelerators like Beyond, like Skew, and others that you can find out there. I'm sure many of you have potentially thought about crowdfunding, and I think it can be a great resource at a certain stage. If you're pre-revenue and you think you have an amazing product and you want to raise money for that production run, Kickstarter is a great option. You can raise $30,000, $50,000 to get an initial run going. Maybe more. But as you scale, I think there's kind of a gap for the usefulness of the crowdfunding sites. I think you can get those early stage, production runs funded there, but then to use them again effectively, you get a little bit bigger and you start to amass a following. That's when you want to kind of tap into those things again, where you have a built-in audience where you can kind of say, hey, come join it. You love our product, be a part of it. So those are options along the way. And then as for the funds, again, I think that Twitter is a great discovery vehicle for it, and talking to the fellow founders. Who are they raising from? Do they know angels in the network? And just really trying to build your Rolodex from there.
Yeah, I found both of my initial partners at Expo West by attending that show. So the shows were really impactful for my brand early on. I got a lot of retail business and met my investor team eventually.
That's great. So there's proof in the pudding that they can work. I see a question here from Akua on, sorry if I'm pronouncing your name incorrectly, on how do you figure out your valuation? Is there a formula to go about and do it? Yeah, again, stage. I think early on, when you don't have a lot of data to point to, there's a lot of valuation methods that don't work. There's a common one is to use multiples, multiple of revenue or net revenue to value your business. But if you're really early, it's not going to be a completely meaningful number. And then you can look at comparable transactions. What have other companies sold for in the industry? What have they raised money at? But if you're in a bar business and you're doing, sub $1 million, and you say, well, RX sold for 5x their sales, so I'm going to use 5x here, and that's my valuation. There's a little difference there from they scaled their business. They took out a lot of the risk, and that's why they got that number. At the early stage, it's a good starting point, but you have to be prepared to walk that number down a little bit, because you still have to prove that you can eliminate all those risks, like those RX bar founders, from producing your product consistently, from growing and finding your audience and scaling. So it's not a perfect answer, but that's a start to think about it, hopefully.
We have a few more questions on our end that were sent directly to me. What are some effective ways or networks in which to connect with angel investors that have been historically invested in your space?
The angel networks, I think there's, seeing a lot of the companies that we've invested in, they've had angel networks on their cap table. And to Veronica's point, it's local groups and kind of understanding, one, who's around you, looking up local angel syndicates in your area. I think the Naturally Network is a great one, from Boulder to New York to LA and the Bay Area and others. Who's there? Who's part of those communities is a great tool to discover who's out there. Other angel groups or associations, I think that's probably one of the best ones to try and start there. Look at the Naturally lists. I think one comment on where we are in today's cycle and kind of what's going on in the greater economy, those angels might be harder and harder to find. As markets take a hit, I think angels that historically have a tendency to step back from many industries for a period of time, and we may be coming into that.
Okay. Another one is, do you recommend marketing in any way, for example, through LinkedIn, that you are raising, or is that taboo / poor etiquette?
I think focus is the best answer. So meaning, if you're reaching out specifically and say, I see X company in your portfolio, it's similar to what we're doing, or in the space, we'd love to have a conversation, no problem. I'm totally open to LinkedIn outreach. If it's a blanket thing, which you can tell pretty easily, I'm less interested. I think it can be double-edged if you see a deck from multiple sources. Everyone's looked at it, but you haven't had the ability to fundraise. I think it's dangerous to do. So I think the more focused you can be on outreach, the better.